Okay, how are you students? Today's our topic is IAS 33, earning per share. The name of the topic is IAS 33, earning per share. Right now, what exactly is earning per share? Means means how much company earn per share, how much company earn per share. Now some student confuses between EPS, means earning per share. See, EPS and DPS. Look at here, there is one word which we call EPS, and there is another word which is called DPS. DPS stands for dividend per share. DPS stands for dividend per share. Now look at here. Earning per share means how much company earn per share, and DPS, dividend per share, means how much from out of those earnings how much company has distributed, how much dividend company has distributed. Wait, for example, EPS of company is 10. EPS of a company is $10 per share, and out of these $10 company has distributed $3. Out of these $10 company has distributed dividend of $3. That means company has retained $7 per share, $7 per share. So I repeat, there are two things. One is EPS, earning per share, and the other word is DPS, dividend per share. There is a big difference. Earning per share means how much company has earned per share, and dividend per share means how much company has distributed from that earnings. So for example, if the earning per share is $10 and company has distributed $3 per share, that means company has retained $7 per share. Okay, so now right now we are going to discuss EPS, earning per share. Now what's the importance of EPS? Normally, this is a very important performance indicator for shareholders, or I say the share price of company is dependent on EPS. The share price of company is dependent on EPS. Giving you one example. For example, this is the share of ICI and this is the share of Unilever. The EPS of ICI is $10 per share, and the EPS of Unilever is $100 per share. Now just think, this ICI share is earning only $10 per share, and this Unilever share is earning $100 per share. Now you tell me, which share is very valuable, which share is more valuable? This one. This is earning more. This company, this share is earning more. So it's very simple. The higher the EPS, the higher the stock market price, share price. The higher the EPS, the higher the stock market price. So in simple words, we can say EPS is, sorry, we can say market price, stock market share price is dependent on EPS. Share price is dependent on EPS. The higher the EPS, the higher the market price. Now just think, as the market price, stock market price is dependent on EPS. That's why in past many directors, many accountants were involved in the manipulation of EPS. So when these cases came out, so finally International Accounting Standard Board has decided to launch a proper accounting standard, on EPS. Okay, and the name of this IAS is IAS 33. IAS 33, earning per share. IAS 33, earning per share. Okay, now let's start this standard. Now wait, first of all, I'm sure by now you all must have studied income statement. Okay, this is the extract of income statement. I hope you remember this PBIT. PBIT is profit before interest and tax. This PBIT is not at all the property of ordinary shareholder, because from PBIT we deduct interest expense. From PBIT we deduct interest expense, that is finance cost. So now we get PBT. PBT means profit before tax. From this profit before tax, we deduct tax expense. Obviously, we have to pay tax to government. So finally, we get profit after tax. Finally, we get profit after tax. And now, sometimes this profit after tax is also not the property of shareholders, ordinary shareholders. So from this profit after tax, we have to deduct less preference dividend, if any, preference dividend if any. Now listen, wait. Now after this, the profit we'll get is called profits attributable to ordinary shareholders. Profits attributable to ordinary shareholders. What do you mean by profits attributable to ordinary shareholder? Means this profit, this final profit only belongs to ordinary shareholders. Only ordinary shareholders are the owners of this profits. Why? Because see, PBIT means we have already deducted all operating expenses. Now we have after PBIT we have deducted interest also, and we have deducted tax, and sometimes if there is any preference dividend, we have deducted that as well. So this is the profit whole soul belongs to ordinary shareholders. Now what we do, we put this profit, see the formula of EPS, we put this profits attributable to ordinary shareholder in the numerator. What I have written, PAT means profit after tax less preference dividend, divided by total number of issued ordinary shares. Total number of issued ordinary shares. So that's how we get earning per shares, means how much profit company earned on one share, each share, on each ordinary share, okay. So this is the basic formula we have derived. EPS is equal to C, profit after tax. PAT means profit after tax less preference dividend if any, divided by total number of issued ordinary shares, okay. This is the formula of EPS. Now, for simplicity, for simplicity, in the whole next 2-3 classes, I will give you this numerator ready-made. I will give you this numerator ready-made, and I'll be using the word earnings. I'll be using the word earnings, okay, for this numerator. So my dear students, whenever earnings in my question, whenever earnings is given, that means the ready-made numerator is given. If earning is given, that means the ready-made numerator is given, okay, right, in my questions. Now wait, so this is the formula. Now let's do one first very basic question, easy question. My dear student, this is, let us say, is your accounting period, 1st January, right? Let us say at the beginning of the year, where number of shares is 10,000. Very basic question. We are starting with very basic baby question. Number of, and at the end of the year, number of shares is also 10,000. Okay. And you have earnings of 20,000, right? So as a first question, we are not changing the number of shares. Let us say at the beginning of the year, the shares are 10,000. At the end of the year, the shares are 10,000. No change in the shares. And you have earnings of 20,000. So let's calculate the EPS. EPS. What's the formula of EPS? Earnings divided by number of shares. So earnings is 20,000 and number of shares are 10,000 shares. So very simple. The answer is $2 per share. Answer is $2 per share, right? Okay, the answer is $2 per share. Now, let's go to the real life. What happens in real life? Real life, these number of shares are not constant at all. In real life, these number of shares are not constant at all. Company issues new shares. Company may issue new shares during the year. Okay. So there are different types of share issue which we have to study in this topic, and they are very interesting. So the first issue which we are going to study is number one is full market price issue. Full market price issue. What do you mean by full market price issue? What do you mean by full market price issue? It means, wait, company needs cash. For example, company needs cash to 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 build a building, to buy a non-current asset, anything, and company has decided to issue new shares and to get the cash from the market. So company has issued new shares in the market, and company collected the market price, the actual market price which is going on, the full market price which is going on in the market. So what do you mean by full market price issue? Look at me. Company has issued new shares. Company has issued new shares, and in return company got a bag full of cash. Company got a bag full of cash, the full market price. Okay, means company is getting new resources from the market. Okay, so keep in mind one thing. This full market price issue is not a free issue. This full market price issue is not a free issue at all. This full market price issue is not a free issue at all. Okay, getting? Now let's do one question of full market price issue, and I'll teach you how to tackle this full market price issue. And one more thing, I'll teach with a different style. Intentionally, I'll solve it wrong. I'll solve this question wrong so that you try to understand the main issue with this full market price issue. You try to understand, you will try to identify the mistake, and then I'll correct in front of you. Okay, we'll go in this way. Now you don't need to copy anything because I'll provide you the slides. Okay, right. Now, my dear student, we are doing a separate new question now. Okay, a separate new question. Now you have your accounting period 1st of January 2020 to 31st December 2020. 1st of January 2020 to 31st December 2020. At the beginning of the year, the number of shares issued were 10,000. Now open your eyes. At the mid of the year, company issued new 5,000. See, I have written full MP issue. Full MP. MP means market price. Company issued new full market price issue of 5,000 shares. Okay. Now that means from the mid of the year, the total number of outstanding shares became 15,000 shares. Okay. At the beginning of the year, it was 10,000, and at the mid of the year, company issued new 5,000 shares. Company issued new 5,000. So 10 plus 5 is 15,000. So at the end of the year, the total number of shares issued are 15,000 shares. Okay. Now, what are the earnings in this question? Look at the screen. The earnings are $12,500. Earnings are $12,500, right? Okay, so let's do it wrong. First, let's do it wrong. What did I do? I wrote EPS, look at here, EPS, simple, simple, simple. What is your earnings? 12,500 is the earning. It will go in the numerator. And what I did, I just pick these year-end shares. I just pick these year-end shares for the denominator, 15,000 shares. So if you divide 12,500 divided by 15,000, it's, I think, around how much? 1.67 per share, I think. Still you can do it. Still you can try it. Wait. So sorry. Make the earnings. Wait. Make the earning 20. I'm gonna change the earnings. I'm gonna change the earnings. 20. Make the earning 25,000. Okay. 25,000. Now do it. 25,000 divided by 15,000 is how much? It's 1.67. Okay. Now 1.67 per share. Now if somebody does this question, this is total wrong. This is total wrong. Now what's the logic? What's the logic? Now listen. When we calculate EPS, we calculate it for the whole year. When we calculate, now listen very carefully, when we compute EPS, we compute it for the whole year, right? This is the complete year EPS. So what is in our at the back of the mind, that these are the total shares, these are the total shares outstanding for the whole year. These are our, this is our total investment, this is our total investment outstanding for the whole years, and this investment generates this much profit. In the denominator we are writing the investment, the total investment, the total outstanding shares, and this total outstanding shares generated this much profit. So do you think, just listen, do you think that these 15,000 shares were outstanding throughout the whole year? Do you think these 15,000 shares were outstanding throughout the whole year? The answer is no. No. See, first 6 months only 10,000 shares were outstanding, and in the last 6 months, yes, 15,000 shares were outstanding. Yes or no? So this working is wrong. First logic. Second logic. Just think, look at me. This is a full market price issue. What's the name of the issue? Full market price issue. Means at the mid of the year, just think, at the mid of the year, company issued new shares. At the mid of the year, company issued new shares, and company received a bag full of money. Company received a bag full of money. So this new bag full of money is invested from the mid of the year. This new bag full of money is invested from the mid of the year. So definitely this bag full of money helped us earning profits in last 6 months only. That means in the numerator only last 6 months profit is included from that investment. In the numerator only last 6 months profits has been included from this investment. So when in the numerator only last 6 months effect is included, so in the denominator we'll also take the effect of last 6 months. In the denominator we'll also include the effect of these shares for just last 6 months. That's why we have to calculate a new thing, that is weighted average number of shares. We have to include a new thing, that is weighted average number of shares. I repeat the logic. Now listen it again. Listen. Just think, these new shares we have issued at the mid of the year, and when we issued these new shares at the mid of the year, we received a bag full of money, and that new bag full of money is invested from the mid of the year. So this bag has generated profits just for the last 6 months, and those profits are included in this numerator. So in the numerator only last 6 months profits are included. So when in the numerator you have taken the effect of last 6 months, so definitely in the denominator also you have to take the effect of last 6 months. Okay, so that's why you need to calculate weighted average number of shares. Okay, and when we calculate, I'll calculate in front of you, don't worry. And when we compute weighted average number of shares, we will include only last 6 months effects of these new shares. Okay, let's see how we do it, please. Weighted average, WA means weighted average number of shares. Now it's very simple, it's basic maths. Bracket open. First of all, in the first 6 months, how many shares were outstanding? Only 10,000. In the first 6 months, how many shares were outstanding? Only 10,000. So 10,000 times 6 upon 12. See, we have taken 6 months effect of these shares. Plus now we are here at the mid of the year. See, at the mid of the year, we already had issued 10,000 shares, plus on the mid of the year we issued a new 5,000 shares. So 10 plus 5, 10 already, plus 5 new. 10 plus 5 is 15,000. So in the last 6 months our outstanding shares are 15,000. Okay, so what we'll do, 15,000 times 6 upon 12. That's it. Come on. Now, what's the answer? I think this is 12,500 shares. Yes, this is your weighted average number of shares. 12,500 shares. 12,500 shares. Okay. Now, let's calculate the EPS again for you. The formula of EPS is earnings. Earnings is how much? Earnings is 25,000. Okay. Divided by weighted average number of shares is 12,500 shares. So your EPS is $2 per share. Okay. This is the correct treatment. So have a look. So now listen the summary. Whenever there is a full market price issue, whenever there is a full market price issue, we always compute weighted average number of shares. Whenever there is a full market price issue given in the question, we will always compute weighted average number of shares. We'll always compute weighted average number of shares. Okay. And second thing, for full market price issue, for listen very golden words, for full market price issue, the effect of full market price shares, the effect of full market price new shares are always taken from the date that share issue has been done. And in this question, these new shares are issued at the mid of the year, so we have taken the effect of these new shares from the mid of the year. Okay. And why? What's the logic? Now I'm giving you logic again. Why full market price issues, if full market price shares are included from the date they are issued? Because it's not a free issue. It's issue of resources. It's issue in exchange of resources. We receive a bag full of money. And that bag full of money is invested from that date. So that bag gives us earning for only few months. So that's why in the numerator we have taken few months profit. So in the denominator we'll also take few months shares. That's it. Did you understand, students? Did you understand? There is a question, what if it is at the start of the year? Yes, if the full market price issue on the first day, then we will take the full year effect. Yes. Okay. Now let's do a very small practice. Just now we have to calculate weighted average number of shares. A small practice. Let's do it. Okay, so this is the accounting period. Open your eyes. 1st January 2020 to 31st December 2020, right? And now at the beginning of the year, the number of shares were 8,000 shares, and there are two full market price issue in this 1 year. Okay, on 1st April 2020, there is a first full market price issue of 3,000 shares. On 1st November 2020, there is a second full market price issue of 2,000 shares. Okay, so now I invite you all to calculate weighted average number of shares. Come on, do it. It's basic maths. You have 2 minutes. Quick. Come on, do it. Have a look. 8,000 shares. See, first 3 months, the outstanding shares are 8,000, and 8 plus 3 is from this date 11,000 shares. Next, April to 1st April to 1st November is 7 months. Next 7 months, the outstanding shares are 11,000. Now look at here. Then finally, 11 plus 2 is 13,000. Wait, 13,000, and these 13,000 shares are outstanding for only 2 months. Okay, so let me do it very easy. First 8,000 shares, the outstanding time is 3 upon 12 plus 11,000 times how much? 7 upon 12 plus 13,000. From this date, the shares become 13,000. And how many? These 13,000 shares are outstanding for last 2 months, times 2 upon 12. Okay, so tell me the answer, please. Tell me the answer, final answer. What's the final answer, please? 10584. Okay, so that's how you calculate the weighted average number of shares. That's how you calculate the weighted average number of shares. That's how you calculate the weighted average number of shares. Okay, so now to cut the story short, final summary. Whenever you see a full market price issue in the question, you need to calculate weighted average number of shares. The first thing. Number two, full market price shares are always included from the date it is actually issued. Okay, from the date it is actually issued. And what's the logic? Because full market price issue is not a free issue. Full market price issue is not a free issue. It's issue with resources, with cash. We receive a new bag full of cash, and that bag full of cash is invested from the date the shares are issued. So definitely these new shares gives us earnings for few months. That's why in the numerator only few months profit is included. That's why in the denominator also we will include only few months profit. We'll include only few months profit, right? Got it? Now Now we are going to do the second issue. The second issue is bonus issue, please. The second issue is called bonus issue. Now, before we move on, I would like to show something very interesting, something very different related to bonus issue. Okay? We are stopping EPS right now and we are learning something new. Listen, we all know what is bonus issue. For example, company does not have cash to pay cash dividends. Okay, so company gave free shares to existing shareholder, company distributed free shares, free shares to existing shareholder. This is bonus issue. Okay, now wait, hope you remember the formula of EPS. Hope you remember the formula of EPS. I just taught you the basic formula of EPS. In the numerator you write profits, in the denominator you write shares. The basic formula, I would like to write basic formula: profits divided by shares, profits divided by shares, profits divided by shares. Okay, so now just think, look at me now, assume a bonus issue. Think about a bonus issue in the mind. What is bonus issue? Company issued new shares, company issued new shares. So when company issued new shares, your denominator will go up. When company issues new shares, the denominator goes up, the denominator goes up. Okay, and now the bonus issue is a free issue. Not a single penny, not a single penny company received, not a single penny company received from this bonus issue. So see, there is no change in profits. Not a single new amount will be invested. Not a single new amount will be invested. So no change in numerator, but the denominator will go up. So this will definitely reduce your EPS. Whenever any company do bonus issue, EPS goes down. Just think, whenever any company issues bonus shares, EPS goes down. See, because bonus issue will only increase the denominator. Bonus issue will only increase the denominator. Bonus issue won't change your numerator, won't change your profits, won't increase your profits, because nothing is coming. No new investment is coming from shareholders. Just think. Okay, now it is said, just listen, it is said that in stable markets normally shareholders don't like bonus issue. In stable markets like foreign markets, US market, or the markets which are very stable, the markets which actually follows the EPS, the market where political conditions are stable, where all the other economical factors are stable, and the share price purely follows EPS. Share price purely follows EPS. In such markets, shareholders do not like bonus issue. Now, giving you one example. Now, be very careful. It's extra learning for you guys. Let us say now be very active. It's very interesting. Honestly, it's very interesting. Listen, there is a company, the name of the company is A. Company A, how do calculates EPS like this? They have earnings of $1,000. Their earnings are $1,000, and they have only issued 100 shares in total. to date, they have only issued 100 shares. So 1000 divided by 100 makes $10 per share EPS. Okay, $10 per share is the EPS of this company. Okay, and with this EPS, open your eyes, with this EPS, the market price is equal to 20 per share. In the stock market, the market price is 20 per share. When the EPS was $10, the stock was trading in the market. The stock was trading in the market at $20 per share. Okay, this is the existing condition of this company. Now, open your eyes. How many shares company has issued? 100 shares, total 100 shares. Okay, total 100 shares. And now out of these 100 shares, 10 shares are owned by Mr. X. Mr. X, he's a shareholder. Mr. X, he's a shareholder of this company. And out of these 100 shares, Mr. X owned 10 shares. Mr. X owned 10 shares. 10 shares. Okay. So now, can you tell me right now, Mr. X wealth before bonus issue? There is no bonus issue by the company. 10 shares, Mr. X owned 10 shares. And what is the share price right now? 20 pounds. The share price is 20 pounds. So 10 shares multiplied by 20, the wealth is 200. The wealth is $200. I've written pounds. Let me change it. Dollars. The wealth is $200. Okay. So right now there is no bonus issue. Forget about bonus issue. Company's EPS is 10, and at this EPS the market price per share is $20. At this EPS the market price per share is $20, right? So Mr. X owns 10 shares of this company, and 10 shares multiplied by the share price per share is $20. 10 shares multiplied by $20, the wealth right now is $200. Have a look, relax, have a look. Now Now, my dear student, let us say this company decided to make 100% bonus issue. 100% bonus issue. You know what is 100% bonus issue? Means whatever shares company has already issued, company will issue the same number of shares. Company will distribute the same number of free shares. Okay, 100%. In past, in the basic level, you have issued 10%, 20% bonus issue. Now this is 100% bonus issue. Now let's see what is the EPS after this 100% bonus issue. We all know that bonus issue is a free issue. Bonus issue is a free issue, so no new resources, no new resources. So the numerator, the profit will remain same. The profit will remain same, but as company has issued the equal number of new shares, so 100% bonus issue, so the denominator will get double. The denominator will get double. So 100 shares plus 100 shares makes 200 shares. Okay, 200 shares. Company has issued same number of new shares to each and every shareholder. So now what's the effect on EPS? Open your eyes. 1000 numerator remains same, but denominator gets doubled. So EPS will be $5 per share. EPS will be $5 per share. EPS will be $5 per share. Okay. Now I have already told you in the beginning of this question that we are in the stable market right now. Assuming we are in the stable market, so market price will follow the EPS. Market price will follow the EPS. So as open your eyes, as the EPS became half, as the EPS became half, so market price will also became half. Market price will also became half. So existing price was $20 and now it became $10 per share. Okay. Now a very interesting thing is coming. Very interesting thing is coming. Look at here. Look at here. Mr. X wealth after 100% bonus issue. Mr. X wealth after 100% bonus issue. See, already Mr. X had 10 shares. Already Mr. X had 10 shares, but now after 100% bonus issue, Mr. X will receive the same number of new shares. He had 10 shares. Now he'll receive 10 shares more. So now his shares became 20 shares. Now his number of shares became 20 shares. But what's the share price now? What's the share price now? What's the market price? Market price is now $10 per share. So can you calculate the wealth? 20 into 10, again $200, again $200. Look at the fact. See, before bonus issue the wealth was $200. Before bonus issue the wealth was $200, and after bonus issue the wealth again was $200. No change in the wealth of shareholders. Look at with your open eyes. The existing wealth was $200, and now the new wealth is also $200. The new wealth is also $200. So no change in shareholders wealth. So why will they like it? Why will they like it? No change in shareholders wealth. Just imagine. And you know what happened? Oh, just look at the economic reality of this transaction. See, just the number of shares gets doubled. Just the number of shares get doubled and the share price became half. See, just the number of shares gets doubled and the shares price remains gets half. So no extra benefit. Even sometimes, frankly speaking, sometimes when I teach kids and I give these examples to beginners, what I say, I say this: listen, just assume shareholder is a cute little kid. Shareholder is a cute little kid, and shareholder was holding $10 note. Shareholder had $10 note. So what company did? Company said, come here. And company said, give me your $10, give me your $10 note. And in return, company has given $255 note. In return, company has given $255 note, and this shareholder is saying, oh, two. So this is that's not a benefit. What company has done? Company has converted his $10 note into two $5 note. Company has converted his $10 note into two $5 note, nothing else. The wealth is same. So now what's the central idea? What's this now? These are the golden words which I'm going to say. Theoretically, listen, theoretically, because of this bonus issue, shareholders won't get any benefit or any loss. See, the wealth is same. Wealth is not increasing, neither increasing nor decreasing. It's same. So that means no benefit or no loss to shareholder because of this bonus issue. See, the wealth remains same. So there is no extra benefit or no extra loss to shareholders. Listen carefully. Have a look. Have a look. Okay, now again we are coming back to the EPS. It's very easy. I hope you don't forget the full market price issue thing. I expect. Now, now let us say this is accounting period 1st January to 31st December. Very basic question. Number of shares at the beginning of the year is 10,000. Okay. And for example, on 1st of August 2020, Company made a 1 for 10, 1 for 10, 1 for 10 bonus issue. Wait. Company made a 1 for 10 bonus issue. Now let us say the earnings here is $22,000. Okay. Now the examiner is asking to calculate EPS. EPS, very basic EPS. See how we do it. The formula of EPS is earnings divided by shares. So earnings is 22,000. And now listen my words very carefully. Listen my words very carefully. Just think over it. Is this a full market price issue or a bonus issue? Is this a full market price issue or bonus issue? The answer is bonus. If this were a full market price issue, then obviously I agree. I will be computing weighted average number of shares. I'll be computing weighted average number of shares. And in that case, it will only be included. In that case, it will be only included from the date the new shares are issued. If this were a full market price issue, then, but as it's a bonus issue, it's a free issue, free. Its objective is to create dilution. It decreases your EPS. So always remember that bonus issue are adjusted from the beginning of the year. Bonus issue are always adjusted from the beginning of the year. Bonus issue are always adjusted from the beginning of the year. Okay. So how we do it? 10,000 are the beginning shares, and this is 1 for 10. 1 for 10 means 10%. 1 for 10, 1 upon 10, 1 upon 10 into 100 is 10%. So that means you are issuing new 10% shares. You are issuing new 10% shares. So 10,000 increased by 10% is 11,000 shares. So in the denominator, we'll write that's it. That's it. Let's write one easy line. Bonus now. So my dear student, if whenever somebody told you to calculate EPS and there is a bonus issue in the question, simply adjust from the beginning of the year. And why? Just think over it, because this is not full market price issue. If this was a full market price issue, then yes, you take it from that date when the shares are issued. As this is a bonus issue, free. So its objective is to create dilution. Its objective is to decrease the EPS. So you simply adjust from the beginning of the year. Okay. Now one basic maths thing, not difficult at all. Go very slow. Whenever you find, listen to me, whenever you find a bonus issue in the question, we adjust it from the beginning of the year. That's done. But we do it through bonus fraction. We adjust bonus shares from the beginning of the year through bonus fraction, a new thing, bonus fraction. Now, how do we calculate this bonus fraction? Very basic maths. Listen, just assume, just think, at the beginning of the year, the total number of shares were 100%. The existing total is always 100%. At the beginning of the year, we were at 100% shares. Okay, 100%. Now, we made a new issue of 1 for 10. We made a new bonus issue of 1 for 10. 1 for 10 means 10%. 1 for 10 means 10%. That means we issued new 10% shares. That means we issued new 10% shares. So 100% plus 10%. So 100% plus 10%, this makes 110%, 110%. Okay, I repeat, existing number of shares were 100%. We issued new 10% shares. So 100 plus 10 is 110%. Now wait, if you remove this percentage sign, we divide it by 100. We divide it by 100. Now let's do cancellation. This 0 and 0 will be cancelled. So 11 upon 10 is your bonus fraction. In short, we call it BF. In short, we call it BF, bonus fraction. Okay. In short, we call it BF. Now, what we do? Listen, 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 listen. Look at here. Look at here. What's the formula of EPS? Earnings divided by number of shares. Earnings divided by number of shares. Wait. Just write the number of shares. Just write the number of shares at the beginning of the year. Just write the number of shares at the beginning of the year and multiply it by bonus fraction. You will get the same answer. Do it. So 10,000 shares times 11 upon 10. 10,000 shares times 11 upon 10 is 11,000. And now you do it, the answer will be same. Now I know what you guys are thinking. Sir, you just wasted the time. Sir, you just wasted the time. The answer was same. The existing working was easier than this current working. Yes, apparently right now it looks like this. But as we have to take other classes, many classes as well, after today's class, this will be the only method we have to follow, this bonus fraction thing, because some few things are hidden from you right now. Okay, few things are secrets right now. So whenever, let me summarize it, whenever you find a bonus issue in the question, how you adjust it, you always adjust bonus shares from the beginning of the year. You always adjust bonus shares from the beginning of the year, and you adjust it through bonus fraction. You adjust it through bonus fraction. Okay, and that's how you do bonus fraction working. Okay, now I'm going to give you basic maths practice. I'm giving you different bonus issue and you have to calculate bonus fraction quick. Listen, this time it was 1 for 10, that's why 10%. That's why I added 10%, okay? That's why I added 10%. If it is 1 for 5, if this is 1 for 5, then 1 upon 5 means 20%. If this is 2 for 5, then 2 upon 5 means 40%, okay? So you have to adjust accordingly. I hope you guys are no more kids. Let me give you a few questions, okay? Now this is 1 for 5. This is 2 for 5. This is 3 for 5. 1 for 3. This is 1 for, or make it 1 for 4. Come on, do it. I need bonus fraction for all these 4. I need bonus fraction for all these 4. Come on, do it, do it, do it. Okay, let me do it. It's very easy. Listen, 1 for 5 means, first of all, 1 for 5 means 20%. How you get 20%? 1 upon 5 into 100 is 20%. Okay, let's start. Existing total is always 100%. For any question, the existing number of shares total are 100%. And as this is 1 for 5, so it's 20%. So 100 plus 20 is 120%. Okay. And when you remove this percentage sign, you divide it by 100. Now, I hope you remember the timetable of 2. So simply wait. This 0, 0 cut, and this 2 times 5 and 2 times 6. So answer is 6 upon 5. The bonus fraction is 6 upon 5. Very simple. So this is all BF. 6 divided by 5. For 1 for 5, the bonus fraction is 6 upon 5. Okay. Now let me do for 2 for 5. Now wait. Existing total for anything is 100%. And 2 upon 2 for 5 means 40%. 2 for 5 means 40%. 2 for 5, what do you mean by 2 for 5? That shareholder, for every 5 shares, they will receive 2 more shares. For every 5 shares, they will receive 2 more shares. So 100 plus 40 is 140%. And if you remove this percentage sign, you will divide it by 100. Now, cancel 0, 0. And you hope you remember the timetable of 2. 2 times 5, 2 times 7. So it's 7 upon 5. One more, 3 for 5. Okay. Existing total was 100%. And 3 for 5. 3 for 5. 3 upon 5 into 100 is 60%. So you issued new 60% shares. This is 160%. And when you remove percentage sign, you divide by 100. Now cancel 0 and 0. 2 times 5, 2 times 8. 8 upon 5. Easy peasy. Now, 1 for 4, 1 for 4. 1 for 4 is 25%. 125% divided by 100. Come on, cancel it. 5 upon 4. Okay. I hope you got it. So now it should not be a challenging task for you. So let's summarize again. We just studied 2 issues. One is full market price issue, and the second one is bonus issue. The first is full market price issue, and the second one is bonus issue. Okay. What we do in full market price issue, whenever you see any full market price issue in the question, you calculate weighted average number of shares. Already done. And whenever you see a bonus issue, you simply adjust the bonus shares from the beginning of the year, okay? And we do it through bonus fraction. Okay? Right? Now, we are going to do the most interesting and the most logical thing of this class now. This is a big concept which I'm going to give you. Okay, my dear students, before we start this question, first of all, listen to me very carefully. Just let's agree on few things, one or two things. The first thing is, for a common shareholder, for a common man, for a common shareholder, investor, EPS is everything. For a common shareholder, EPS is the most important thing. Means if a common shareholder sees EPS going up, he becomes happy. And when the common man sees EPS going down, he starts selling the shares, he starts dumping the shares. Okay, so for the common shareholder, EPS is everything. Number one. Number two, each and every shareholder is not a chartered accountant qualified. A common man also invests, engineers, doctors, a normal businessman also invest in stock market, also buy shares. So each and every shareholder is not a chartered accountant. And in your basic studies, I'm talking about basic financial accounting studied, you have studied the qualitative characteristic of framework. You have studied the qualitative characteristic of framework understandability. I hope you have studied understandability. Understandability means when an accountant prepares a financial statement, it should be that much understandable, that a common man with some knowledge of accounting and business can easily understand. Okay, so that means it should not be that much difficult, that only chartered accountant understands this financial statement. Okay, this is what understandability is. Right? So for a common shareholder, EPS is everything. Number two, all shareholders are not chartered accountant, and we have to prepare financial statement for a common shareholder. And number three, I told you through that special example, that because of bonus issue, existing shareholders do not get a single pound benefit or single pound loss. The wealth remains same. Okay, right? Let's start the question. It's very easy. First of all, this is the first year. 1st of January 2020 to 31st December 2020. 1st of January 2020 to 31st December 2020. Okay, your EPS, listen, as there are no new shares in the first year, there are no new shares. At the beginning of the year, the number of shares were 10,000. At the end of the year, it is also 10,000. At the beginning of the year, the number of shares are 10,000. At the end of the year, the number of shares are again 10,000. Okay, so if the formula of EPS is earnings is 20,000, okay, and number of shares are 10,000 shares. It's very easy. $2 per share. $2 per share. And now at the end of the year, this EPS will be calculated and the financial statement will go to the shareholders home. They will see the EPS. That's the end. The first year is done. Very easily. Now second year. Now see, this is the second year. Open your eyes. Second year, please study with heart, please. And the second year, there is a bonus issue of 1 for 5. I hope you can see. There is a bonus issue of 1 for 5. Now, we all know, as there is a bonus issue in the second year, so bonus shares are always adjusted from the beginning of the year. Bonus shares are always adjusted from the beginning of the year. So we will adjust these bonus shares right from the beginning. And now can you tell me the bonus fraction? We adjust the bonus shares from the beginning of the year. and we do it through bonus fraction. And I just taught you the bonus fraction of 1 for 5. Look at here. The bonus fraction for 1 for 5 is 6 upon 5. The bonus fraction for 1 for 5, 1 for 5 means 20%. See this working. All of you please see this working. It's 6 upon 5. So now how I'm going to do it? EPS is equal to earnings. Now, what are the beginning number of shares? 10,000 shares times 6 upon 5. Okay. Can you tell me the answer? The answer is, I think, 1.67. Yes. Now I'm going to discuss some comments. Please listen to me very carefully. I hope by this time, you guys are no more kids. You know this fact that whenever company issues a financial statement of 1 year, company also gives comparative numbers of last year. Company also gives comparative numbers of last year so that shareholder can compare the performance. Shareholder can compare the performance. Now let's do it wrong. Now what happened? Wait. At 31st December 2021, company issued the financial statement of 31st December 2021, and company reported this EPS. Company reported this EPS in 31st December 2021, and with the comparative, company reported this $2 per share. In the comparative, company reported $2 per share in the same financial statement. Look at here, 1.67 for 2021, 1.67 for 2021, and $2 per share for 2020. Now, just think what shareholder will see, what a common shareholder will see. They will see last year the EPS was $2 and now it's only 1.67. So shareholder will see that EPS is going down. So they will perceive that the performance is going down. EPS going down means the performance is going down, and they will start selling the shares. There will be a panic in the market. But just think, do you think it's a real downfall of the company? Just think, this decrease in EPS is because of the decrease in performance? No, the performance is same. Just think, just see, let me give you evidence. Last year earning was also 20,000. See this, last year earning was 20,000 and this year earning is also 20,000. This year earning is also 20,000. So look at my video. The performance was same. The performance was going smooth, not going up, not going down. Earnings were same. Last year earnings was 20,000. This year earnings was also 20,000. So there is no defect in the performance of company. It's same. But if you see the EPS, the EPS number has gone down. Why? Just because of bonus issue. This thing is coming. And now just recall that example which I taught you. Because of bonus issue, when EPS goes down, so market price also goes down. Yes, but shareholder has received extra shares. But shareholders are also receiving extra shares. So there is no loss. There is no harm in bonus issue. There is no good or no harm in bonus issue. So if you show this last year $2 EPS to shareholders, they will assume that the performance has gone down. See, 2 with 1.67, this will misguide the shareholder. They may perceive it as if the performance is going down, but in reality the performance has not gone down. In reality, the performance has not gone down. The performance is intact. It's straight. So Now we need to take the effect of bonus issue in the last year as well. We need to take the effect of bonus issue in the last year as well, to do comparison like with like, otherwise my dear students, shareholders will be misguided. They will think that performance has gone down, because I told you, for a normal common shareholder, EPS is everything. For a common normal shareholder, EPS is everything. When EPS goes down, they think that company is going down and they started selling the shares, but in reality the company has not gone down. So we need to correct this defect. How? Look at here. So now, whenever, listen my words, whenever there is a bonus issue in any accounting period, so when you issue comparative figures, of that financial statement of last year, you will also take the effect of bonus issue in last year as well. How? See, EPS, its earnings is 20,000, and last year shares are 10,000. And how are we going to take the effect of bonus? Through bonus fraction. See, right, bonus fraction 6 upon 5. Can you calculate now? It's 1.67 per share. Now see, that means when at 2021, at the end of 2021, when we'll issue the financial statement of 2021, we'll report the EPS of 2021 as 1.67, with the comparative EPS of last year is as 1.67 also. So now the shareholder will not be misguided. See, the performance is same, so the EPS is also same. And there is no loss to shareholders. Shareholder has not paid any loss. No loss on shareholder, my dear. No loss on shareholder. We already discussed it with logic, with clear logic, we have discussed it. Okay, so keep this summary in your mind. Let me tell you the summary. Keep this summary in the mind, that whenever in any accounting period, if there is a bonus issue, whenever in any accounting period, if there is a bonus issue, so while issuing the financial statement, and while reporting the comparative EPS of last year, we'll restate word, listen my word, we'll restate this EPS. This is called, see, this is called restated EPS. Okay, and we'll take the effect of bonus in that last year financial statement as well. Why? To make comparison like with like. And listen, if we won't do this, so the shareholder will be misguided. Now wait, one interesting thing. One student raised the hand. One new student raised the hand. He said, sir. I said, what? Sir, this work is very difficult. Let's don't do this restated work. Let's just report this thing. Let's just report this $2 last year and this year 1.67, and write in the notes to the account that because of bonus issue, that this EPS went down. Because of bonus issue. Just write in the notes, and shareholder will do these working themselves. These workings themselves. So you know what I replied to that student? I said, all shareholders are not chartered accountants. Earlier I told you all shareholders are not chartered accountants. So you have to break it down for shareholders. You have to prepare food for shareholders so that they can eat easily. You have to do spoon feeding to shareholders. Got it? Have a look. Giving you 1 minute. Have a look. Take your time. Now, one very basic maths. I hope you all studied in schools, grade 6, grade 7 thing, very basic maths. I'm going to tell you basic maths. Wait. Do you know this fact? Do you know this fact that if in the denominator it is written 6 upon 5, look at me. Do you know this fact that if in the denominator it is written 6 upon 5, and if you take it in the numerator, if you take the same number in the numerator, it becomes upside down. We call it reciprocal. For example, in the denominator, if it is written 6 upon 5, when you bring it to numerator, it becomes 5 upon 6. It becomes 5 upon 6. Okay. So now wait, look at the screen. Look at the screen. See, look at the restated EPS. In the denominator, we have written 6 upon 5. So if we bring this 6 upon 5 in the numerator, if we bring this 6 upon 5 in the numerator, what we'll do, this 6 upon 5 will become, look at here, 5 upon 6. This 6 upon 5 will become 5 upon 6. Okay, now wait, what is left here? Here you have 20,000 divided by 10,000. Here you have 20,000 divided by 10,000, which is the existing EPS. Yes or no? So now there is one more formula. Simply write the existing EPS. Simply write the existing EPS and multiply it with the reciprocal of bonus fraction. Multiply it with the reciprocal of bonus fraction. You will get the ready-made restated EPS. That's it. See this. I repeat, just simply write the last year EPS, and multiply it by the reciprocal of bonus fraction. Multiply it by the reciprocal of bonus fraction, you will get it. Let me tell you the ready-made formula. My dear boys and girls, let me tell you the ready-made formula for this. See this. Okay, so the ready-made from now onwards, giving you a ready-made formula for restated EPS. What is this? Last year EPS multiplied by 1 upon BF. 1 upon BF means reciprocal of bonus fraction. That's it. Ready-made thing. And you know, in future questions, you will only be able to use this formula, nothing else, because last year data won't be given to you. Last year data won't be given to you, so you have to do it like this. So you have to do it like this. Last year EPS into 1 upon bonus fraction. Last year EPS into 1 upon bonus fraction. Okay, got it? Got it, dear student. Have a look. Take your time. Did you understand? Okay, now let's move to one last question. Let's move to one last question of practice question of today's class. Now wait, this whole question I taught you just to explain the concept, and from now onwards we'll follow this. But you know, In real life, the earnings will change. In this question, just to explain you the concept, I maintain the earnings constant. I maintain the earnings constant, but in the real life, the sales, cost of sales, and everything gets changed every year. So in from next question, we'll discuss the real life thing. There will be changes in earnings, but still, whenever there is a bonus issue, still whenever there is a bonus issue in any accounting period, we will do we'll restate the last year EPS like this. Okay. Now I'm giving you one question. You have to do it on your own. Okay. So now you have earnings in the first year. The earnings is $50,000. In the second year, let us say earnings is $60,000. Okay. So what you have to do, listen to me very carefully. Listen to me very, very carefully. First of all, you have to solve the first accounting period normal EPS. Then you have to work out the second accounting period EPS, and then you have to calculate the last year restated EPS. Okay. Now, let me explain you. At the beginning of first year, the number of shares issued were 20,000. At the beginning of the first year, the number of shares issued were 20,000. On 1st of October 2020, you issued a full MP. I hope you remember full MP issue of 5,000 shares. So, and at the end of the year, so number of shares are 25,000. In the next accounting period, you did a 2 for 5, 2 for 5, 2 for 5 bonus issue. Come on, let's do it. In the first year, the earnings is 50,000. Second year earnings is 60,000. Work out both EPS plus restated EPS as well. Do it. Come on, boys. Do it. Listen. In the first year, there is a full market price issue. So I already told you, whenever there is a full market price issue, we always compute weighted average number of shares. Very easy. One thing. Second thing, and full market price issue are always included from the date they are issued. Okay. So now, in the from 1st January to 1st October, the first 9 months, the outstanding shares are 20,000, and then we issued new 5,000. So 20 plus 5 is 25. So in the last 3 months, 25,000 shares are outstanding. In the last 3 months, 25,000 shares are outstanding. So how we are going to do it? Look at here, 20,000 times 9 upon 12 plus 25,000 times 3 upon 12. What's the answer? Can you tell me? What's the weighted average number of shares? 21250. It's 21250 shares. Okay. Now the EPS will be very simple. It's earnings. What's the earnings? Earnings is 50,000. 50,000 divided by 21250 shares. So this will be I think 2.35. Okay. Have a look. This is your current year EPS. Okay. So we'll calculate this and we'll send this to shareholders. Very simple. Now, what will happen in the second year? In the second year, there is a bonus issue. In the second year, there is a bonus issue of 2 for 5, 2 for 5, 2 for 5 is 40%, 2 for 5 is 40%. So first of all, with 40%, the bonus fraction I already taught you is 7 upon 5. BF bonus fraction is 7 upon 5. I've already taught you. Okay. So how we'll do it? The earnings are $60,000. The earnings are $60,000. Okay. And bonus shares, I already taught you, are always adjusted from the beginning of the year. Bonus shares are always adjusted from the beginning of the year, and they are adjusted through bonus fraction. Okay. So at the beginning of the year, you have 25,000 shares times 7 upon 5. Come on. What is the EPS now? It's 1.71. Okay, this is the second year EPS, 1.71 per share. Now the one last thing. One last thing. Listen. Whenever in any accounting period there is a bonus issue, and when you report the comparative EPS of last year, you restate it, right? You take the impact of bonus issue in that. So how we are going to calculate the restated EPS? I already taught you. The restated EPS will be simple. Last year EPS, write down the last year EPS 2.35. Last year EPS multiply by the reciprocal of bonus fraction, multiply by the reciprocal of bonus fraction. So normal bonus fraction in this question is 7 upon 5. Normal bonus fraction in this question is 7 upon 5. So the reciprocal will be 5 upon 7. 5 upon 7. So it is 1.67 per share. Okay. So that's the end of the story. That's the end of the story. That when in the second year in 2021, in the 2021 you will report 1.71 EPS, and with this 1.71 you will report the comparative EPS of 1.67. You will report the comparative EPS of last year of 1.67 per share. Now let me give you, in the end, let me give you a short summary of the class. What we studied the introduction of IAS 33, earning per share, EPS, basic EPS. Now, and what's the basic formula of EPS? The earnings divided by number of shares issued, earnings divided by the weighted average number of shares issued, simple. And we studied two different types of share issued in today. The first is full market price issue. And full market price issue means you issued new shares and you receive a bag full of money, the current share price. Okay, so it's the share issue with resources. And whenever there is a full market price issue, we calculate weighted average number of shares, one thing. And the second thing, full market price issue is always included from the date when the shares are issued. And what's the logic? Because we use the new resources, we use the new cash from the date these new shares are issued. So when in the numerator we are taking few months profits effect, so that's why in the denominator also few months, comparison like with like. That's it. Number second, whenever there is a bonus issue in the question, bonus issue is a free issue. So bonus issue are always adjusted at the beginning of the year. Bonus shares are always adjusted at the beginning of the year, from the beginning of the year, and we do it through bonus fraction. Okay. And one last thing, don't forget it. It will help you in next class. Whenever there is a bonus issue in any accounting period, and you report comparative EPS with that accounting period, you restate last year EPS by taking the effect of this bonus issue last year. And how you do it? This is the formula. Restated EPS is calculated as last year normal EPS into 1 upon BF, into the reciprocal of BF. Okay. I hope you understood the class. We have discussed everything, even we repeated the things many times, okay? So that you can grasp things easily, okay? So now it's time to say bye. See you in the next class. Take care.